Howdy, Jacob here. Today we're looking at Robert Half in the professional services industry. Growth on revenue from 4.7 billion in 2014 to 6.4 billion in 2023. Return on invested capital looks absolutely astounding in the averaging in the probably mid to high 20s%. Gross margin relatively flat, operating margin relatively flat, but actually down from 9 years ago. The balance sheet shows 732 million cash on hand with zero short-term debt, zero long-term debt. Very healthy balance sheet. No concern on that front. Cash from operations shows a pretty hefty production of free cash flow. So we're looking at almost double the cash from operations from 9 years ago with actually lower capital expenditures. Use of cash being almost entirely on their repurchasing of shares, which is inflating the return on invested capital, meaning that they probably aren't going to be giving you a 30% return on their investment unless they are buying back shares that are stupendously cheap. But yeah, not a whole lot of reinvesting back in themselves. We're probably looking at a 15% of that, and then 5 to 10% on acquisitions, and then really maybe 50% or so on share repurchases. The dividend paying out 30% or so. Um, so very heavy on the share repurchases and paying a dividend, which again, nothing wrong with that. That's giving you money essentially, literally as a dividend, and then essentially through share repurchasing. But again, thinking about it from a capital allocation standpoint, you want this company, the management, to be buying back shares that are cheap. Again, it's not bad to be doing dollar cost averaging because you're essentially going to get the return that the business is doing. But if the business is only giving you, 5%, 6% return, then buying back shares is going to be giving you a 7, 8% return. It's still not great. It's not a great, not the best form of capital, best use of capital. So keep that in mind. But let's start making some assumptions here. I think it probably won't be too crazy difficult. Let's see. I think 5% seems pretty reasonable here. 5%, and then 15p price free cash flow based on, just put it in line with the market and say that gross relatively the same, return on invested capital is higher, but they're not actually reinvesting at those rates. They're just giving us um, dividends and paying back shares. So uh, I think 15 seems reasonable to me. I like that free cash flow is consistently higher. Let's do a range here. Let's do 7.5 and 9. Let's say 8 billion market cap, buyback 2% of shares would be about 160 million. And I think that, yeah, they might actually be able to afford more than the 160 million. So 160 million and the 200 million from the dividend is 360. That's probably 75% of free cash flow. We can make it 2.5% share repurchases. And then the dividend, let's increase that maybe 6%. Let's do 7%. Because again, there's the 5% increase in revenue that we're assuming per year, but then there's also share repurchases of 2.5%. So the dividend on a per share basis can actually increase greater than revenue and still end up being a less payout at the end of 7 years. So pretty interesting company right now. It just needs to fall 29% to get a 50% return. Given our initial analysis, strictly based on numbers, there's no in-depth review here. This is just looking at their basic income, balance sheet, free cash flow statements, so cash from operations and everything. So or statement of cash flow. Goodness. But yeah, it looks fairly interesting. Just slightly high at this point in time. I would want to see it fall a bit more before, yeah, I do more research and see if this company is really, really a buy or not. So hopefully you enjoy the video. Hopefully, you have fun doing your own analysis on the stock and have a great rest of your day. Thank you.